Japan's yen just collapsed to its weakest level in 40 years. The government spent nearly $50 billion trying to stop it. Then America went in to help, the first time the US and Japan have done the two together since 1998, and guess what? The yen is already giving back those gains. This is not just Japan's problem, this affects you. And if you don't understand why, you need to stay locked in for the next few minutes. Quick background for anyone who needs it, and zero judgment if you do. Japan has the third largest economy on Earth. The yen is one of the most traded currencies in the world. When the yen moves, global markets feel it. Here is the simple version. In 2021, $1 US got you about 105 yen. By 2026, $1 US gets you 163 yen. That means the yen lost more than 1/3 of its value against the dollar in just 5 years. 1/3. Gone. And that might sound like a foreign exchange problem, something for traders in suits to worry about, but it is not. A weak yen means everything Japan rims gets more expensive. Food, energy, raw materials. And Japan imports a lot, so ordinary Japanese people are paying more for basically everything. Sound familiar? So how did the yen get this weak? 2 words: interest rates. Here's the problem in one sentence. America raised interest rates aggressively to fight inflation. Japan kept theirs near zero to keep their economy alive. When the US pays 5% interest and Japan pays near zero, global investors pull their money out of Japan and put it into America. That selling of yen drives the yen down. It is basic economics. But the consequences for Japan are anything but basic. And here is why Japan cannot just raise interest rates to fix this. Japan's national debt is 260% of its GDP. That is the highest debt-to-GDP ratio of any major economy on Earth. If Japan raises rates, their interest payments on that debt become enormous. The whole system could crack. So they are stuck. Weak yen or debt crisis. Pick one. That is their nightmare. On July 30th, 2026, the yen hit 163 to the dollar, a 40-year low. The last time the yen was this weak was 1986. Ronald Reagan was president. Top Gun had just come out in cinemas. That is how far back we are talking. Japan's finance ministry responded by spending nearly $59 billion, yes, billion with a B, selling dollars and buying yen to push the exchange rate back down. That is one of the biggest single currency interventions in history. And it worked. The yen jumped from 163 back to a 57. Problem solved, right? But here is where it gets really wild. The US Treasury stepped in too. The Federal Reserve Bank of New York, on behalf of the US Treasury, sold euros to buy yen. This is the first time the US and Japan have jointly intervened in the yen market since 1998. During the Asian financial crisis. That is 28 years ago. And Trump personally announced it. He said, and I quote, "They have a weakening yen and they wanted a little bit of help. And we're always there for Japan," which is a very casual way to describe a multi-billion-dollar currency operation. But here is the unusual part that experts flagged immediately. Instead of selling dollars to buy yen, which is the normal move, the New York Fed sold euros to buy yen. Why? Because selling dollars would weaken the dollar and contradict other US economic goals. So they used Europe's currency instead. Economists called this weird and unwise. One expert said, and I am paraphrasing, "The last thing you want is to give markets any reason to ask questions." And now for the part that should worry everyone. The intervention is already unraveling. The yen started 2026 at 156 to the dollar, fell to 163 at its worst, jumped back to 155 right after intervention, and by August 11th, just 2 weeks later, already fallen back to 159. They spent nearly $60 billion and the yen gave back half the gains in 2 weeks. And this is the fundamental problem with currency intervention. It can slow the fall, it can create a temporary bounce, but it cannot fix the underlying reasons the currency is weak. The interest rate gap between Japan and the US is still there. The debt problem is still there. The structural weakness is still there. Until those change, the yen will keep sliding. Okay, but why should you, a young American, care about Japan's currency? Great question. Here are 4 reasons this hits closer to home than you think. 1. Japan is the single largest foreign holder of US Treasury bonds, over 1.1 trillion. If Japan needs to sell those bonds to fund yen intervention, US bond prices drop and US interest rates go up. That means higher mortgage rates, higher car loan rates, higher credit card rates. For Americans. 2. A weak yen makes Japanese exports cheaper. Toyota, Sony, Nintendo all become better value compared to American competitors. That puts pressure on US companies and US jobs. 3. When the yen weakens, it drags other Asian currencies with it. The Korean won, the Chinese yuan, the Thai baht. That creates instability across the entire Asia-Pacific region, which is a massive chunk of global trade. 4. And this is the big one. The fact that the US had to step in to save the yen tells you something important. The global financial system that runs on the US dollar is under stress in ways that now require active management. That is not normal. That is a big deal. So what happens next? There are really 3 possible scenarios. Door 1, the best case. The US Federal Reserve starts cutting interest rates. That weakens the dollar. The interest rate gap between the US and Japan narrows. The yen recovers on its own without more intervention. Markets stabilize. This is what Japan is desperately hoping for. Door 2. The muddle-through scenario. The Fed stays on hold. Japan and the US keep intervening periodically to prevent a total collapse. The yen bounces up and down. Markets stay nervous. Nothing is resolved, but nothing fully breaks either. This is the most likely near-term scenario. Door 3. The scary one. The yen keeps falling despite intervention. Japan runs low on dollar reserves. They start selling US Treasury bonds to raise dollars for more intervention. That floods the bond market. US interest rates spike hard. Global borrowing costs surge. The whole thing becomes a financial crisis that spreads everywhere. Most experts say this is unlikely. All right, let's bring it home. Here is what happened. Yen hit 1.63 per dollar, a 40-year low. Say 10. Japan spent 59 billion to stop the slide. Say 3. A US jumped in 2. First joint intervention since 1998. Say 4. Euros not dollars, and experts called it weird. Sought 5. The yen already gave back half the gains in 2 weeks now. 6. This affects US interest rates, jobs, and global stability. The yen crisis is not just Japan's problem. It is a window into the stress fractures of the entire global financial system. When the world's third-largest economy needs emergency help from America to keep its currency alive, that is a signal worth paying attention to. Drop a comment. Did you know the US was involved in Japan's yen intervention? Does this change how you think about the dollar? I want to know. Like the video if this helped, subscribe for more, and I'll see you in the next one. Peace.